Okay, in this section, we are going to solve the portfolio management's beta related questions. Okay, we had some question left of the earlier part, which is your CAPM. So we'll solve that first and then we'll move on to beta questions. Okay, so in last lecture we did what? Question number 23 we did. Okay, so now we'll do question number 24. Okay, A Limited has an expected return of 22% and standard deviation of 40%. B Limited has an expected return of 24% and standard deviation of 38%. Okay, so both these things are given. A Limited has a beta of 0.86 and B Limited has a beta of 1.24. Okay, beta is also given. The correlation of coefficient between return A and B is 0.2. Okay, the correlation of coefficient is given. The standard deviation of market return is 0.2. Okay, that is 20%. Suggest what they are asking. Is investing in B Limited better than investing in A Limited? See, now how we will take this decision? We will see return and risk. Okay, so now see how we will take the decision. We'll see return and risk of it. Okay, so more return and less risk. So which one is it? So return of A is 22% and return of B is 24%. Okay, so return of B is seemingly better now. Okay, standard deviation is 40% in A Limited and standard deviation of B Limited is 38%. Since it is less and has more return, so we will select B. So is investing in B Limited better than investing in A Limited? Yes. If you invest 30% in B Limited and 70% in A Limited, what is your expected rate of return and portfolio standard deviation? Okay, so what they are asking is, if we invest 0.3 in 30% in A Limited, okay, and 70%, 30% in B Limited and 70% in A Limited. So how will we invest? If we invest, what return will we get? Okay, return what we get, we'll do weighted average. Okay, into what is the return I get in B Limited? It is 24%. Okay, equal to M plus, and next 70%, 0.7 into how much? 22. Right, M plus MRC, we get 22.6% as expected return. Now, what is the portfolio standard deviation? That is, they are asking risk. So how do we calculate risk? Can we do weighted average? No. For doing weighted average, we need the perfect correlation. Here there is no perfect correlation. The coefficient of correlation here is 0.72. So here there will be some difference. So what we'll do, we'll put it in formula. What is the formula? What is our portfolio? It is, let's suppose our portfolio is A and B, right? A and B. So A and B is my portfolio. Okay, so what we need to find? First we'll find variance. Okay, variance is what? Square, and next we'll do root. Okay, so now what will happen? A square plus B square plus 2AB, right? So now if we write it in security terms, how will we do it? Weight of A square into risk of A, okay, square, that is your standard deviation A ka square, okay, plus your weight of B square into standard deviation square of B, that is your variance of B, plus 2 into weight of A into weight of B into your COV AB. What is your COV AB? It is standard deviation of A, standard deviation of B into standard correlation AB, right? You can write this also. So if we put this in the formula, we'll get how much? 0.1374. Okay, as my variance of portfolio. So 0.1374 is my variance of portfolio. If I have to do it in standard deviation, I'll get 0.3706 or 37.07% as a risk. Okay, next, what are they asking? What is the market portfolio's expected rate of return and how much is the risk-free rate of return? Okay, so they are asking two things. What is the expected market rate of return? That is your required rate of return and your risk-free rate of return. Okay, now to calculate your CAPM, what do you need? You need RF plus RM minus RF into beta, right? Beta of security. Now what all figures are given here? They are asking this and this. So 3 and 4 is available and 1 and 2 is not available. RM is given in question. Yes, the standard deviation of market, return of market. Where is return of market? Where is return of market? Return of market is also unknown. Okay, I only know what? I only know return. Okay, CAPM I know. How much is it? See, they are asking us what? Markets portfolio expected rate of return and risk-free rate of return. Okay, markets portfolio expected rate of return. So they are asking RM. Okay, RM they are asking, it is unknown. Okay, 3 is unknown. So 3 and 2 they are asking, 4 we have, beta we have. How much is it? A is it? It is 0.86 and B it is 1.24. Okay, so for CAPM it is what? Required rate of return. Okay, we'll assume is equal to what? Your expected return. Expected return is equal to your required rate of return. So how will we solve it? If you want one data, we can put it in equation and we solve it. If you want two data, then how we'll do? Firstly, we'll assume that RF is same for both securities. Both securities. Okay, now we can solve it. See, now CAPM is equal to expected return, right? So for security A, what is my expected return? It is 22 is equal to RF is not given in question plus RM minus RF. RM we don't know. Okay, and do we know beta? Beta we know. Beta is 0.86, right? So now if we solve this, we'll get (22) RF plus 0.86 RM minus RF. Okay, so this is what we get. Okay, this will be my equation 1. My equation 2, security B will be 24 is my expected return and RF plus 1.24 RM minus RF. Okay, we cannot solve this, so I have just put it in equation. Okay, now what we do is subtract 2 from 1, 2 by 1. Okay, 1 minus 2, or simply you can write 2 minus 1. Okay, now what we are doing? 24 is equal to RF plus 1.24 RM minus RF. 22 is equal to RF. Okay, 0.86 RM minus RF. Okay, now my sign will change, minus minus minus. Okay, now 22 minus 24, it is 2 RF, it will get cancelled. Now 1.24 minus 1.24 RM minus RF minus 0.86, 1.24 minus 0.86. We are getting 0.38 RM minus RF. What is RM minus RF? It is 0.2 divided by 0.38, right? So Rm minus Rf is equal to, we'll get 5.26. If we solve it further by substituting in it, we'll get our Rm as 22.74 and Rf as 17.48. Okay, we have to just substitute the value next. So this was the tricky point here. Okay, what is the beta portfolio of if A's weight is 70 and B's weight is 30%? Okay, so they are asking beta portfolio. So how will we calculate? 0.7 into, just do simply weighted average into how much the beta it is. A is 0.86 m plus and 0.3 into 1.24. So my beta is 0.974. Okay, it was very easy with the fourth point. Okay, so in this question only the third point was quite tricky, so that I explained. We also have read it in our concept book. Okay, we'll move on to the next. Okay, I told you that I will show you, right? Which question was it? See, if Rm and Rf is required to be calculated in question and data is only available for expected return, okay, required return we had, so Rm and Rf we need to find, and beta of two securities are given, then make two CAPM equations for both securities using available data and then solve these equations mathematically to arrive at Rm and Rf. Okay, so that's what we did. Okay, we made two equations, we needed Rm and Rf, and for required rate we assume that required rate is equal to expected rate. Expected rate was already given in question, so we used that. Next, question number 25 is easy, you can solve it by yourself. Question number 26 is also easy. Now we will solve question number 27. Okay, what it is we'll see. An investor holds two stocks A and B. An analyst prepared ex ante probability distribution for possible economic scenarios and the conditional returns for two stocks and the market index as shown below. Okay, so what is it? That security A, security B and market's return probability is given below. Okay, in three economic scenario, which is growth, stagnation and recession. Okay, the risk-free rate during the next year is expected to be around 11%. Okay, determine whether the investor should liquidate his holdings in stocks A and B, or on the contrary make fresh investments in them. Okay, so it is asking a decision. Okay, CAPM assumptions are holding true. Okay, now they are asking CAPM. Okay, what is the formula of CAPM? It is RF plus beta Rm minus Rf, right? So what all data is given here? We have Rf here. Okay, we will have Rm. Okay, by multiplying with probability we'll get Rm. Rf we have, Rm we have. So beta, there is no beta. Okay, how can we calculate beta? Okay, just think, how can we calculate? We studied a formula. Beta of security can also be calculated as beta of security is equal to covariance of security and market divided by variance of market. Using this formula, can we find beta of security? Yes. Do you have covariance? We can find, right? We can find covariance. Okay, and standard deviation, variance also we can find. Okay, we'll have expected return and we'll have individually returns also. We'll take deviations of it and we'll square it. So it will become our variance and multiply it with probability, of course. Okay, so how to solve it, we'll see. Firstly, what we need to do is we need to find the expected return. Okay, for if we find expected return, then only we can find correlation between the security and market, right? So firstly, we need to what? We need to find covariance, okay, between security and market. See, security 1A is different and security B is different. Okay, so security A with market and B with market, we have to find different, okay, and both the securities beta will be different. Okay, we need to give decision. So we'll just start. Okay, first what we'll do, we'll take covariance between security A and the market. There are three stages. We have been given probability of each. Okay, now x is what? X is the annual return given in the question. Okay, this is my annual return. Okay, conditional return, I mean conditional return given in question. So this is conditional based on the whether it is growth, stagnation or recession. Okay, now what we need to do, we need to find expected. How we'll do? Probability into your x. Okay, p into x, will get 11.5 as expected return. Okay, expected return, x minus x bar, we'll get an amount. Okay, now we have x minus x bar. Okay, next what we do is we'll take market's security, market's expected return. Okay, market's expected return was 0.4, 0.3, 0.3. Okay, and we'll denote market as y. Okay, we have market 18, 13 and 3. Okay, what is market? 18, 13 and 3. Okay, now we'll do p into y. Okay, we'll get what? We'll get expected return of market. Okay, now expected return of market, we need it for variance of market, right? So for variance of market, we'll do variance into we'll do square of it and we'll do probability into, so the summation will get variance. Okay, variance only we need, we don't need standard deviation. Okay, so standard deviation we are not taking. Next, now what we want is we want covariance of security A and market. Okay, security A, x minus x bar into y minus y bar. Okay, and security x minus x bar into p. Okay, into probability, the total if we do, we can get our covariance between security A and market. Okay, it is 106 and 0.24. Now we need to find beta of security for CAPM. Okay, for CAPM we need security beta. Okay, so CAV, covariance of A and market divided by variance of market, that is 106 divided by 78.96. Okay, here we got no. So how much will get? 1.35 as beta. Okay, this beta will be used in CAPM equation. Okay, next for security B, we'll do the same procedure. Okay, we'll put probability, we'll take annual return 2015 8 minus 8, 2015 minus 8, x minus x bar we do. Okay, now let's take the security B as Z. Okay, let's take it as Z so that we won't get confused. Okay, in an exam you can do anything, but here for less confusion we'll do Z and Z bar. Okay, so my expected return will be 10.1 and my Z minus Z bar will be this. Okay, now what we have to do, we have to do find covariance. Okay, y minus y bar we already have done in question number in part 1. Okay, so here already I have y minus y bar. Okay, I'll directly take here 7.8, 2.8 minus 13.2. Okay, 7.8, 2.8 minus 13.2, I took it here. I'll multiply it. Okay, and with probability, if you do it, we'll get variance. Okay, 106.678. We'll divide it by the variance of market, so we'll get 1.351. Okay, the variance of market is 78.96. Wait a second, there is something different going on here. Let me check it. Okay, 9.9 into 7.8 into my probability 4. So I'm getting 106.68. Okay, it's the same value divided by what? Divided by securities variance. Sorry, markets variance 78.96. So I'm getting 1.351. Okay, this is my beta of B. Okay, now it's time for decision making. So how we'll do? So firstly, what we'll do is we'll find required rate of return. What we found beta. Okay, we found beta. So now what we'll do we have RF, right? We have RF as 11% given in question. 11% was given in question. Now beta we have, okay, of each securities, and RM we have, right? Do we have RM? Market return we have 10.2. Okay, we have every data. Okay, so I'll get 9.924 and 9.912 as security A and B's return. Now we'll compare this with the expected return. Okay, expected return which we calculated earlier. Okay, our expected return of security A and security B. Okay, I will calculate it. Our required return is evident here. Okay, it's 9.924. Okay, now I'll see now what we are doing here in comparison. We got required return from CAPM. Okay, and we have to compare it with our MPT theory's expected return. Okay, so that's what also in question in concept book it was written. See, when we see it in decision making part, okay, on basis of CAPM for evaluating stocks, compare required return on stocks as per CAPM with expected return on stocks as per MPT. Okay, so required return is more as per CAPM and expected return. Okay, this expected return is what we will get in the market actually. Okay, but our required return is what we need. Okay, so if what we need is more than what we expected in the market, that is what is we get in the market, we will sell the share because it is overvalued. If required return is less than what we expect, is less than what is expected in the market, that is market return is more, then it is undervalued, our expectation is undervalued, so we'll buy the share. If it is equal, just it is correctly valued, so buy or hold the share. Now what is happening here? Our required rate of return is 9.92 only, but our expected return which will we get in the market is 11.5. Okay, since what we get in the market is more than what we require, so we will buy it. Okay, because it is undervalued. The same thing for both. Okay, so this was a good question, so practice it well. Okay, let's move on to the next question. Question number 28 is very much easy. Okay, so you can do it by yourself. Nothing much is given here. See, probability is given, return of F is given, that is your security, and P is your market. Okay, it is given, and what you need to calculate? You need to calculate the expected return and market portfolio and the covariance between them. Only that much you have to calculate. Okay. between the market and security, and beta for the security. Okay, beta for security you have to calculate. It's very much easy. If you apply the concepts and formula, you'll be able to get it. Okay, not very much. See, first they have taken standard deviation of security, okay, and then they have taken standard deviation of market, okay, and then covariance, okay, covariance of market divided by variance of market. What we'll get beta. Okay, so that's what they have asked. It is very much easy, you can do it. 29 also very much easy, you can do it. Okay, you just have to find the beta coefficients. You just have to find beta of security A and B. Okay, so what we'll do, we will find covariance, okay, between them, okay, covariance between them, and we will find it. Okay, very much easy. Next, question number 30. It is a good question, we'll solve it in the class. So only 3 questions are remaining. Okay, 34, 31 and 30. Okay, let's do 30. The following information is available in respect of security X. Okay, they have given CAPM or equilibrium return as 15%. Okay, your required return is given here. Your market return is given here as 15%. Trading 7% treasury bond at $140. Covariance of market return and security return is given as 225. Covariance has been given in question. Coefficient of correlation is also given in question as 0.75. Okay, you are required to determine the standard deviation of market return and security return. Okay, so we need to find standard deviation of market return. So how will we calculate standard deviation of market return? What is standard deviation of market return? Question number 30, right? Question number 30. What do you need to find? Standard deviation. Standard deviation of market is equal to what? Okay, this we need to find. Okay, and securities also. Okay, securities return we need to find. Now, we need to find this, but how can we find? The standard deviation concept is of Markowitz. Is there anything given here that relates to the past data, probability, anything? No. Everything seems to be of CAPM. Okay, so we'll write I'm just telling you the flow. Okay, how to flow. Okay, CAPM equation will write RF plus beta RM minus RF. Okay, we'll just put in the values. We have given as CAPM as 15%, right? Now RF will hold it for now. Beta is not given in question. RM minus RF. Market return is given here. See, 15%, right? 15% minus RF. Now RF. If you see, what is RF here? RF is just 7% treasury bond trading at 140. Okay. Now, it is 7%. The coupon rate is 7%. But how do we calculate risk-free rate of return? If we ask in the notes, if you see in the notes, here, sir has written here as if you don't know risk-free rate of return, okay, coupon payment on treasury bills divided by market trading price of treasury bill. Okay. What is the market? It is trading at which 140. Okay. So what is the risk-free rate of return? It is RF is equal to what? 7%. Okay. So $7 you will be getting. Okay. We'll assuming face value is equal to $100. Okay. and divided by $140. Okay, now if we do the calculation, 7 divided by 140 into 100 will get us 5%. Okay, 5%. So 5% is my risk-free rate of return. Okay, now if we solve the calculation, if we solve the equation, now we can get beta, right? So what is this? 5% plus beta 10% is equal to 15%, right? So beta is equal to beta 10 beta is equal to 15 minus 5, 10% divided by 10%. Okay, beta 10 beta here it will be, no, so in divide it will be 10%, that is equal to 1. So our beta is 1. Okay, our beta is 1. Now what they have asked in question is, we have got beta here. Okay, they have asked in question is standard deviation of market return and security return. So how can we find out using this beta? Okay, how can we find it? So we have learnt a formula, beta of security is equal to the covariance of security and market divided by variance of market, right? So this is the formula we know. Okay, here do we have variance of market? No, but if we open it up, okay, this is also is equal to, if you open it up we might end up getting something. Okay, what is covariance? It is standard deviation of security into standard deviation of market into correlation of security and market divided by your standard deviation of market into standard deviation of market. What I have done is I have split it into two. Okay, I have just presented it like this. Now security of market and standard deviation of market and standard deviation of market gets cut. So what is remaining? Standard deviation of S into R SN divided by standard deviation of M. Okay, correlation. So this is what we are getting is equal to 1. This is my beta, right? Now if we substitute the values, beta that is 1 is equal to, what is the security? I don't know. Okay, what is RSM? We know. RSM is what? Coefficient of correlation is, wait a second. Here also we can find this thing, right? Variance of market. So how will we find it? 1 is equal to COVSM is 225 divided by variance of market. So variance of market is equal to 225 and variance standard deviation of market is equal to root of 225, that is equal to 225 divided by 225 square root is 15. Okay, 15. So we already know security is M. Okay, RSM we know 0.75, it is given in question, 0.75 divided by your 15, right? If we take 15 there, 15 is equal to security S into 0.75. Security S is equal to 15 divided by 0.75. Security S standard deviation is 15 divided by 0.75, we are getting 20. Okay, so this was quite tricky. Okay, so you need to analyze it like that. If you know formulas, if you know concept, you'll be able to solve it. Next, question number 31. Okay, the following information are available with respect of Krishna Limited. Okay, here Krishna Limited market and return on government bond is given. Okay, the following data is given. Compute beta value of the Krishna Limited and at the end of the year and state our observation. Okay, so they are asking our decision also. and state your observation. Okay, they are asking our decision also. Next, so we need to find beta value. Beta value, how can we find? Using the same formula. Beta of security is equal to beta of security divided by covariance of market divided by security variance of market. Okay, so here we can find variance of market by using Markowitz formula. Okay, so how we'll do? See, you need to just know the flow of the question, okay, so that you can be able to solve it. Now we'll see. Now we'll find annual return of security and market using Markowitz formula, okay, that is MPT. How can we do it? For this first period 2020, we cannot find, we do not have P0 value, so we cannot find it here. So 2021, 22, 23 we can find. 21, 22, 23 we can find. If we apply the formula, P1 minus P0 plus your dividend divided by your P0, okay, we'll get annual return. Okay, so if we do 3 times, we'll get annual return of each year, and we'll get summation of x, and summation of x divided by n is equal to your expected return. Okay, this is basic. The same thing we'll do with market also. Okay, market they have given index. Okay, we'll take this index as price. Okay, so 2130, here it is quite different. Okay, I'll tell you how to do it. See, here they are given average index as 2130 minus 2013, okay, divided by 2013. Okay, I'm getting written as 0.05. Okay, but dividend component also has to be added. Since it is in percentage, we have to first find this percentage and then add this percentage, or else what you can do is plus 0.05. Okay, this is what you will do here, or else what you can do is 2130 into 5%, you will take this value, okay, and you add it with the amount. Okay, 2130 minus 2013, okay, we'll get the same answer. Okay, why are we getting different? Okay, sorry, I took of different value. Okay, 2130 into 5%, right, into 5%, and plus 2130 minus 2013, okay, 117 plus MRC divided by 2013. No, I don't know. So what we'll do is just take the index. Okay, we'll take the return of it, plus we'll add dividend yield to it. Okay, so 5.81% will get. Okay, here 2130 minus 2013 divided by 2013 plus your 0.05. Okay, we'll get 10.81%. Okay, next, you know why didn't we get the answer? Because dividend yield is not calculated on the end part. Okay, in between any value, it is the total. Okay, it is the average of it, so we could not get it. So we'll have to do like this only. Okay, plus 5% yield we have to do it. Okay, so like that for 3 years you will calculate. We'll get total return. Okay, total return 10.81 plus 16.33 plus 16.79 divided by 3 if we do, we'll get 14.64. Okay, as our average market return. Now next what we need to do is, we got average 14.64. Now we'll calculate covariance. Covariance between security and market, how we calculate is deviation of security and deviation of security into deviation of market. Okay, we'll take security as x and security of market as y. So how we'll do it is, see, here we got how much? 12.24. Okay, 12.24% was my individual return. I will calculate deviation. Deviation is calculated by x minus x bar. X bar here, what was it? What was my expected return? It was 20.26. Okay, I'm getting minus 8.02. Okay, so that's what I'm getting, minus 8.02. Okay, like that you calculate for x and y. Okay, and then multiply it. Okay, and then divided by n. Okay, we'll get covariance. Okay, now here only I calculated variance also. Variance is also required, right? Variance of market is also required, so I calculated here. Now next what we need to do is we need to find beta. What is beta? Beta is covariance divided by your variance of market. So covariance of market is 14.12 divided by your variance of market is 22.15 was the total, divided by 3, we'll get 7.38. Okay, so I'm getting my beta as 1.91. Okay, my beta is 1.913. Okay, take 3 decimals. Now what is my observation? What we need to do is we'll calculate the expected return with actual return. Okay, expected return we have got here. Okay, now what is the actual return? Actual return we have to find it. Okay, sorry, this is my expected return, right? This is the return which we will get. Okay, now we will find required return using CAPM. Okay, so how will we use CAPM? CAPM, see, 6% was the risk-free rate of return. Okay, for the corresponding year, what was the risk-free rate? It was 6%, 6%, 6%. Okay, every year it was only 6% only. So we took 6% plus our COVSM. Okay, our beta, we took beta, and we took 10.81 as market return. Market return also we took 3 years. No, 3 years we calculated, so we got 3 years value. Okay, minus our risk-free rate of return, we'll get expected return. Now we got expected return. First one we got 15.20, but in actual return, that is we are getting is 12.24. Okay, since we are expecting more, we are requiring more, so we will sell. Okay, it is overvalued, so we will sell. Next, 25.20 was my required rate of return. Sorry, yes, was my required rate of return, and 32.41 was my actual rate of return, so we will buy it. Okay, 26.64 was my required rate of return, but I'm getting only 16.13 in the market, so I will sell it. Okay, so this was the decision. So we completed question number 31. Okay, it is the same question number 32. Okay, here only one thing you have to keep in mind is that the return on government bond, it is 5, 4 and 5. Okay, every year take this value only. Okay, see here, 5, 4 and 5, take this value only. Rest everything is same, just figures are different. Okay, you will be able to solve it very much easily. Okay, next question number 33 we will do after corporate valuation chapter. Okay, when I will teach corporate valuation chapter, I'll do this sum. Next, question number 34. Now question number 34 is based on your asset beta. Okay, so asset beta concept, you revise it once and then you watch this. Equity of KGF Limited is 410 crores. Okay, and its debt worth is 170 crores. So what is the total value of equity of KGF Limited? It is 410 plus 170, right? It is 580. Now it has two divisions. Printed division segment value is attributable to 74%. Okay, 74% value is the printed division. Okay, and it has asset beta of 1.45. Okay, balance value is applied on spares and consumables division, which has asset beta of 1.20. Okay, KGF debt beta is 0.24. You are required to calculate equity beta. Okay, Now this was the question. Okay, now what we can see, question number 34. Okay, first one we want equity beta. Okay, equity beta we want. So how will we get equity beta? Asset beta is equal to equity beta plus your debt beta, right? If we elaborate the formula, how will we get beta of asset is equal to equity, beta equity into your equity value divided by your equity plus debt. But debt will have tax saving also, so that benefit we have to give it. Okay, plus beta of debt into 1 minus t divided by e plus d into 1 minus t. Okay, so this, in this formula if we put it, we'll get the answer. But asset beta, what is my asset beta? My asset beta is my company's beta. Okay, do we know company's beta? No. So what is asset beta? Is the business value beta. Okay, business value beta we have to calculate. Okay, we have two businesses, two divisions, right? So what is it? It is 0.74% of is attributable to your printer division, and it has a beta of how much? 1.45 plus 0.2426, right? 0.74 minus 1 is 0.26 into how much it is given? It is 1.2, right? So how much will you get? 0.26 into 1.2, 312, and here 0.74 into, we are getting 1.073, right? So what is my asset beta total? Plus 0.312, it is 1.385. Okay, this is my asset beta. So this value will use it here. Okay, to find beta equity of KGF Limited. Okay, 1.385. What is the beta equity? Beta equity is not given. We have to find it, right? We have to find it. Beta equity is not given in question. Value of equity is given. Yes, it is 410 into 410 divided by 410 plus, what is my debt? My debt is 170. What is the tax? Tax anywhere it is given or what? No, there is no tax benefit. Okay, here they have not given tax. Don't assume it. Okay, don't take tax. Okay, if it is not given in question, don't take tax, ignore tax. Okay, plus 170 plus beta of debt is given. Yes, beta of debt is given as 0.24. 0.24 into debt is 170 divided by 410 plus 170. If we solve it, we'll get beta of equity as 1.86. Okay, this is the missing figure. We'll be able to easily solve it. Okay, next. Now this one is the main part. Okay, asset and equity beta if KGF Limited decides to change its debt equity position by raising further debt and buying back shares of equity to have its debt equity ratio at 1.90. So what this question is saying is that the company wants to maintain its capital structure. Sorry, the company wants to maintain its total capital, that is 580 crores, 410 plus 170 crores. But it wants what? It wants to restructure the capital structure. Okay, so what it is saying that debt equity ratio will be 1.9. Okay, so debt upon equity will be 1.90. Sorry, 1.90 is to 1. Okay, this should be the ratio. So if we do, what will be my capital structure? My new capital structure is equal to, equity is equal to how much? 1 divided by 2.9, that is 1.9 plus 1. right? Into how much? Into 580 crores, right? And for debt, it will be 1.9 divided by 1 plus 1.9, right? Into 580. So 1.9 divided by 2.9 into 580. It is 380. Okay, here it is 380, and here it will be how much? 200. My equity will be 200, my debt will be 200. What is my new debt? My new debt, I have to purchase new debt is how much? 380 minus my earlier one, that is 170. It is equal to 210, right? This is what I need to buy, issue new debt and buy back the equity shares. Okay, now how will this information be relevant? Let's see. Assume that the present debt beta is 0.35. Okay, and further the funds raised by way of debt will have beta of 0.40. So here it will be important. So what we need to find here? Again, we need to find beta of equity. So asset beta of asset is equal to beta of equity into equity. How much equity are we getting? The beta of asset will remain same. Okay, we assume that beta of debt remains same. Okay, E divided by E plus D into 1 minus D plus beta of debt into D divided by E plus D into 1 minus D. Okay, 1 minus D. Since tax is not given here, so we'll take beta of asset will take from 1 only. Okay, we assume that it is same only. Beta of asset remains the same, and beta of equity we need to find. Beta of equity is equal to into equity value, how much is it now? 200 divided by 580 plus beta of debt. Now two beta of debt is given. Okay, 0.35 and 0.4. Okay, so we'll take 0.35 into how much is it? It is for the old present data. So 170 divided by 580 plus 0.4 into 210 divided by 580. Okay, we'll solve it. $170 divided by 580 into 0.35. It is coming to 0.1025. Okay, plus 210 divided by 580 into 0.4. We are getting 0.1448. Okay, beta of equity 200 divided by 580, 0.3448. Okay, 1.385. We'll solve it. 0.1025 plus 0.1448 minus 1.385 divided by 0.3448. We are getting beta of equity as 3.296. 299 or 2996. Okay, this is my beta of equity. New beta of equity is 2.996. Okay. So what is the third part asking? Whether the new beta of equity justifies the increase in value of equity on account of leverage. Okay, so what the question is asking, that whether the new beta equity beta justifies the increase in value of equity on account of leverage. Okay, since our leverage increased, our beta also increased. Beta means what? Beta means your risk. Okay, your risk is significantly increased. What was the earlier beta? Your earlier beta you got only how much? 1.86, but since you leveraged it more, you have more beta. Okay, so when you take more leverage, you'll get more beta. Okay, so that's what it is for today's question lecture. Okay, we have completed with portfolio management's beta part also. Okay, so next time we'll start with portfolio management, beta management concept. Okay, till then, tata, bye bye.